Hey everybody, welcome to your weekend review for the week of Monday, November 7th, 2022, and oh, what a week it was. Bonds traded on both sides of unchanged overnight as yields as high as 4.188 topped out on the U.S. Treasury in the overnight and as low as 4.123 before ending the day actually at 4.2140. So got a lot of movement in the Treasury. This led to MBS being down 8 basis points on the open. After being steadily crushed to the most inverted levels in 20 years, the yield curve was ready for a bounce today, where the shorter maturities were outperforming the longer maturities. This pattern often coincides with MBS outperformance, and today was no exception. The short end got a push from several Fed speakers who mentioned that 50 basis point hikes would still be historically fast, and that traders could pivot their anxiety to focus on the eventual ceiling as opposed to how quickly we will get there. The upcoming week will be dominated by the CPI print on Thursday. The street is looking for a 0.7 month-over-month and come in at 8% on a year-over-year basis for the headline number, and 0.5% month-over-month and 6.6 on the core, which excludes food and energy. We will also get some Fed speak this week. Midterm elections are on Tuesday. However, I don't see that that'd be a big market mover depending on how everything plays out. Right now, the story is all about the Fed. Banks will be closed on Friday for the Veterans Day holiday, so everybody has to get everything done by Thursday. With essentially nothing on the economic calendar on Monday, the most notable headline for the bond market was the announcement of 13 new bond offerings, which should be why should we care about corporate bond offerings, but there are several reasons. At the simplest level, corporate bonds are competition and attention against the MBSs. It can also result in Treasury selling as a part of a hedging process. The impact on Monday's issuance glut is compounded by the looming Treasury auction cycle and the also looming CPI report this week. At the end of the day, we were down 21 basis points. Stocks were up 38 points on the day, and the U.S. Treasury came in at 4.214. Right now, the MBSs are right in the middle of a wide range with a ceiling at the 25-day moving average of 98.784 and a floor of 96.891, which is wide and generally leads to a lot of bounciness. With rising rates, the median mortgage payment has risen $558, or about 40% since the beginning of the year. The MBA's mortgage payment to rent ratio has been on a tear since rates have begun rising, though keep in mind that this tends to lag home prices by about 21 months. I'm sure the press will still pick up on it. Landlords reset their rent for an apartment upon renewal. However, the big chunks happen when the tenant moves and the apartment goes into market. So if home prices rise for a year, rent stays the same until the lease expires and so forth. We also got some interesting data from folks at the mortgage data technology company Ingenious. See what they did there? They witty over there. According to their research in 2021, there was a total of 353,000 loan officers, while 234,000 of them originated 3 or more loans. July 15th of this year, there were 276,000 licensed loan officers in the country. Of that total, just 188,000 had done 3 loans year to date, which is a low number. We're getting fairly close to the 2019 workforce levels, in which there was 263,000 total loan officers and 180,000 of which did 3 or more loans. That's kind of my point. 2019 wasn't that terrible, everybody. We can do this.